Welcome back, everyone, to Mike on Money. My name is Michael LeBlanc, Director and Senior Portfolio Manager, and thanks for joining us here every week where we do a live update of what we saw last week in the markets and what we see coming up. And we take a look at different financial topics. Today, we're going to be covering off ETFs, what they are, and when you should use them. They're very powerful tools, and they're something that we can leverage in a portfolio, but should really understand some basics on it. So we're going to take it from the beginning and kind of explain where and how to use the different types in investing and in your portfolios. With that, I'm also going to mention last week, of course, we talked about cryptocurrencies and Bitcoin and Ethereum. And as I mentioned, we did do a 4-part series on that. So if you want to have the links to those that we're rolling out, just go to mikeonmoney.com, send us a message or email us, give us a call, or you can find those on our YouTube channel as well. So those will be coming out. The first one's already out, and the next 3 will be out very shortly. So with that, as always, everything in these videos are for educational purposes only. Always do your own due diligence or speak to a professional advisor before applying anything to your portfolios or to your strategies to ensure that they're right for you and they fall within your risk tolerances. So, so if you have any questions on that, or if you want to look at anything in a portfolio in particular, reach out to us. Again, just go to mikeonmoney.com. So with that, let's jump into things. What we see in the economy, we are looking for the manufacturing report. The PMI for May coming up should be pretty good, actually. I mean, obviously, the big backlog in manufacturing these days is just not being able to keep up with the surge in demand as things reopen. Kind of that pent-up demand being swiping out inventory, so the numbers should be fairly strong. Canada's GDP for March, actually, we've seen that number out just today. 5.4%, big jump up. One of the, I think, the highest growth we've seen in several years at one time, which continues on that inflationary story. And we're also looking for the Fed Reserve Board of Governors, who are going to get together and update on their outlook. Stocks futures, ticked higher on Tuesday. We did have a couple of weeks of slower markets. Things seem to be picking back up, absorbing a lot of that inflation data, but having a good feeling and growth or optimistic view on the growth of the fundamental economy, which is good. And we've seen that pretty much across the markets. And of course, the US markets were closed yesterday for Memorial Day. Canadian markets were weak, which is normal with the lack of volumes and things picking up today. Just what's going on out there. Just a story, 8 kids and none who have doomed coal's future. This is just following up. We talked a couple of weeks ago on one of the states taking, some of the fossil fuel companies to court around damage to the environment, global damage to the environment, and that rule in the court ruled in favor of the companies, the fossil fuel companies. Here we have Royal Dutch Shell, facing the same type of cases out in Australia, and there's a small school run by a nun with 8 kids who have put in for their class action. It has been approved, but it wasn't denied, so it wasn't a victory for the plaintiffs, but it wasn't an outright shutdown for Royal Dutch either. So this is kind of the beginning, probably of a trend that we're going to see around, especially coal, but I would say any fossil fuel company would be protected from. We saw the same idea happen to the tobacco companies years ago. from a stance of going after them for healthcare costs, or countries and states going after them for healthcare costs. And we're probably seeing this ramp up for the fossil fuels. So I would expect in the next year or 2 years, we're going to see more and more of these cases, bigger and bigger headlines, and bigger, or more and more significant rulings being put into place around that. And then on the Canadian front, the telecoms, the regulators, had a ruling last week that they call it a dark period for smaller operators. So this goes back now to 2016 and 2019 when CRTC in Canada changed pricing ruling in 2019, kind of forcing the big operators who control the telecom waves or your cellular waves out there to put in wholesale pricing so smaller operators could afford to buy it at wholesale prices and then offer, a competitive package and be able to still price to retail. So there was a rule in 2019 that overruled a previous rule, or a pricing rule in 2016 that made it really tough on smaller competitors. That 2019 was just appealed, and it got repealed back to the 2016 pricing. So the smaller operators are basically saying we can't operate at that level, and they're asking the Canadian government to step in and overrule the CRTC on this and give them an opportunity to compete in that space. I do think this is probably going to get a fairly good hearing, just simply because we saw the recent Shaw-Rogers merger, taking out one of the big players, maybe not on the telecom side, where Shaw was a newcomer to the mobile market. But certainly the Shaw's growth in the market would have created more competition. And of course, now that's all rolled up into Shaw to Rogers. And of course, Roger owns Fido, so there's less and less competition out there. So it'll be interesting to see where that leads. We'll keep a close eye on and what that might mean for telecom businesses in Canada. What else is going on in the news out there? Pent-up demand, shortages of fuel is causing that inflation number just to creep up. As we saw last week or the week before, Canada saw a 3.4% inflation number for the month of April, and now we're seeing the U.S. go through their 2% number, their 2% target, which is the largest gain since 1992 for the U.S. Not overly concerned, as we mentioned. We were expected the pent-up demand as the reopening started to happen to drive things up initially, and then hopefully easing off inflation a little bit for the balance of the year, but then trending back up again. So this is just that initial spike. We were fully expecting that, and it looks like the market is absorbing it as we were hoping it would. Morgan Stanley is looking to add or buy out almost so far a full ownership in their China venture, where they had a partner over there, and as the partner is putting their shares up for sale, Morgan Stanley is buying up the securities for about $150 million. So just increasing their footprint in China. More mergers and acquisitions. Italy's Ali Group has a $3 billion bid out to buy up their U.S. rival Welbilt. This is the food service equipment manufacturer. So, again, as we've seen, obviously with restaurants and everything being closed for the last year, over a year, not a lot of food equipment being sold for new restaurants opening up or people doing upgrades. So just that, bids out there to amalgamate companies, and the merger and acquisition volume that we've seen in the markets has been moving from sector to sector as each one's been hit and has suffered through the closures. And this is just another example of that. BlackRock is going up against BP's board on the climate change resolution vote. So this is just kind of a follow through. We talked about last week with Exxon. So they had a bit of a proxy battle around their board about focusing the company's direction more towards greener technology or diversifying the company's focus. So BP, BlackRock being a big shareholder, BlackRock being a institutional investor, being a big shareholder in BP, is going to the board to have them, have their say around what the board's policy is going to be about the direction of the company when it comes to climate change and climate resolution going forward. And this law, all leads into those lawsuits. Of course, these companies are looking at the future and what that means and what they have to change going forward to be not only competitive, but to diversify their business as things shift in the underlying economies. On the COVID front, things going well. Obviously, last week when we spoke was the 10 minutes before BC put out their rollout, the rollout numbers or dates. Reopening dates, I should say. So we do have this slow rollout and reopening here in BC. Already, of course, our in-person dining and the restaurants have reopened pretty much right after the long weekend for most places. A little more lax about having a couple friends over with distancing and larger groups outside following protocols. And then June 15th, lifting the travel ban, planned lift of the travel ban, of course, because this is all going to be based on whether we hit certain targets and trends in the numbers. And then September 1st, of course, talking about a full lift. So that's BC. Ontario is doing some slowly, a little bit slower than BC as far as their reopening goes. Quebec started some of their reopening. All going well. I think I heard the number yesterday in BC as far as 18 plus adults. We are at 69.4% with the first vaccine. The second vaccine is well into the rollout here in BC, and they've shortened the time period between the two down to 2 months, even shorter in some cases. And of course, Canada just came out this morning saying you don't have to get the same second shot. So I think what I read, and it was preliminary news I read out this morning, that if you had Pfizer, you'd have Pfizer. If you had Moderna, you could have Pfizer or Moderna. And if you had AstraZeneca, you could have Pfizer. And another big shipment, I think, of Pfizer came in yesterday for Canada, which is good news. So that looks like the rollout of the second shots are going to be accelerated. And hoping that BC, I think now they're estimating second shots by July at some point for most people. So things going well here. And of course, around the world, things improving in the US. Of course, the reopening's happening there. UK, still some challenges in a lot of countries. And as I've always said throughout all this is great for us. This is great, for businesses in Canada, business in the US, businesses in those developed countries. But now the focus has to turn to the rest of the world, because there's a lot of countries that haven't had the financial means or access to the vaccine to be as successful with the rollout or as quick with the rollouts. And until we really get the entire world vaccinated, we're still at risk of these variants. And in fact, I think the WHO mentioned that they've named now two of the very extreme variants with a new name because they've changed so much. And then the risk is eventually that they become resistant to the vaccines. That's a stage we don't want to get to. So until we really want the world to open up, and until we really want travel and things to really open on a global basis, we have to start turning our sights now onto those global numbers. And the EU even came out yesterday saying, they're recommending all countries now maybe not focus so much on the 18, teenagers vaccine, but really focus on the rest of the world at risk, because until we get the variants under control, we won't see that full global reopening happening, at least not, in a manner that we really want to see. So just keep that in mind with the COVID. Things going great here. Let's enjoy that. And we'll keep an eye on as the rest of the world addresses their policies and programs as well. In the U.S. economic calendar, what we see coming up is we're looking for payroll numbers. We saw the private payroll numbers go up in May after surging in April as well. We see that teeter number, as I mentioned last time when we looked at April numbers, they had spiked quite a bit. As I mentioned, not to be concerned, we are expecting a bit of highs and lows on a month-to-month. We're just looking at that trend to continue to grow. So seeing a drop, seeing that drop from April to May is not concerning. There was just April was when the U.S. really first started the reopening, so there was that initial spike, but it continues to be strong numbers as we go through. And we are looking for that stabilization. So where is it going to stabilize? What are all the numbers, whether it's a manufacturing number, whether it's job creation, job losses? We're just looking for a stable growth line, not necessarily looking to set new records every single month as we get back to normal here, as we reopen the economy fully. We are expected to see some updated numbers on Thursday on the jobless claims data. So how many are not getting back to work? So we're really trying to find where in the economy we've lost jobs, right? Which jobs are not going to come back, right? Or which jobs have we lost from full-time to part-time? Because that's going to be a big effect of this reopening. Is yes, we're going to have new jobs coming back, but some areas where we may never see the job numbers get back to where they were. We might have permanently lost in certain sectors a certain number of jobs as companies closed, shuttered completely, or people downsized or became more efficient with technology upgrades through all this. That's the numbers that we're going to be looking for as we see these things reopen. And we're looking for those non-farm payroll increases and the job loss rates for those months. Of course, the Fed Reserve is putting out their beige book, so we're just going to get an update from the Fed Reserve on their outlook on the that economic recovery, how it's going, and what they see coming up for this year. So we'll keep an eye on those their comments and how they word their language there. Again, in the U.S., money is cheap out there. We've talked about it. As long as interest rates stay low, we'll see companies invest in growth, and that's the same for the government. The White House is looking at a $6 trillion budget. And this is, a lot of the things they've already talked about. So the infrastructure deal they talked about, the educational deal they talked about, the money they want to put in climate change and green technology. All these things in themselves look good. Of course, they're borrowing very cheaply right now, so they can borrow more. And if they can get the economy up and running and bring back a lot of new jobs, grow new industries, hopefully they can get some of this debt paid back, or the deficit paid back, or reduced rather, by the time it costs them more to borrow money on their debt side of things. Britain approved the J&J vaccine, although they also cut orders at the same time, as Britain is pretty far ahead on their rollout of the vaccine. They didn't need as much as they ordered, and it took them longer to get it approved. So just as the approval comes through, they cut their order by 10 million doses. In the U.S., Boeing can't get out of the challenges with FAA after, of course, their MAX 8 debacle of a couple of years ago. The Dreamliner deliveries have now been stalled just around confirming data and their inspection methods to meet federal requirements to make sure that the new planes coming off the assembly lines meet all the requirements for the FAA. Obviously, the FAA is going to be very tight on their rulings these days after the MAX 8, two significant tragic crashes there and massive loss of life. They want to make sure everything's correct with any new planes coming off the assembly lines these days. CRV Energy exploring producing a sustainable aviation fuel. So if you're not aware, one of the biggest contributor to greenhouse gases when it comes to burning fossil fuel these days is air travel and planes. So any technology for planes to become either more fuel efficient or burn cleaner or using some sort of clean technology, there's going to be a lot of investment and interest around. And CRV Energy out there is exploring whether they can create a sustainable aviation fuel for airplanes. And so, it's definitely a new technology to keep an eye on and take a look at it. Of course, we've already got electric planes being tested out there in smaller aircraft, but that may lead to larger eventually. But anything around air travel that we can fly cleaner is a technology we'll keep a close eye on. Wayho is to go public, taking their deal at auto data startup. They want to go public with raising about $800 million on a blank check deal. So this is kind of one we talked about IPOs and SPACs a couple of weeks ago. So this is a very similar deal. So it's a reverse takeover where they'll reverse merger onto the market, and blank check just means that they're going to raise as much money as they can, and they're expecting to get over 800 million, including debt valuation for the firm. So another IPO is a little bit slower, as I mentioned. They're losing a little bit of steam. In fact, the SPAC market and IPO market, while it had a massive start to 2021, has now not record lows, but slowed dramatically compared to numbers over the last couple of years. Coming up in Canada, Stats Canada is looking to show the country's economic growth numbers. They're looking for a rate of 6.7. Actually came in at 6.4. So well above expected or average growth for Canada. And then fourth quarter last year, they saw 9.6, which was, of course, that was from the lows of the pandemic closures. So all good news. We are seeing a strong economic growth in Canada as we start to reopen things. We're looking again at the PMI numbers for May to be released coming up here, just to see how that sector is doing. Canada's current account, though, did swing to a surplus for Q1, the first time since 2008. So that's mainly boosted by our exports in oil and lumber, but just showing that Canada is exporting a lot more and doing well as the economy's being sustained, maybe by a couple of sectors, but as things reopen a lot more, hopefully by a more broad base of sectors. The G7 is definitely looking at that minimum global tax, and there's a lot of support out there from it, even from the United States. And this goes to the Biden's government kind of started proposing this. And this is just to close that tax loop where companies can move corporate entities around the world and cash around the world in order to shelter. And U.S. companies are famous for this, for having, Apple, for example, certainly not the worst or the only, I'm not picking on them, not the only ones to do this, setting up companies in Ireland and other tax favorable jurisdictions, and moving profits from Apple US into those companies and then not paying tax on that income. Very common strategy with especially international corporations. So the global G7 are looking to put it into a global tax, meaning you would be taxed a minimum rate, maybe lower than your home country, but a minimum rate for global income. So you would not be able to shelter completely in a really low tax jurisdiction, but you still might be able to reduce your home country's taxation by putting some outside of where your home base is. Dye & Durham, story I haven't talked about since early last year, or early 2020. So Dye & Durham, Canadian-based company, cloud software-based company, went public last year on a really successful IPO. Coming out, I think they were initially going to come out in the mid-teens in price. I think when they launched was about $25, went up to about 40 some odd dollars. pulled back a bit in the markets, and now they've just received a buyout from management led and a shareholder group to take it private again. So they're looking at going back private off the exchange again, which is a big win for shareholders as it jumped back up over the I think it was trading about $45 last I heard. Anyway, around the buyout bid price, and so going back private again. I guess they didn't like the public life. On the dollar front, pretty much the same. It remains weak. U.S. dollars remaining weak. We don't see much changing on the dollars. As we've mentioned over the last many months, pretty much a slow downward trend until the U.S. starts to tighten their monetary policy, just because of the amount of stimulus they're putting into their markets. We don't see the U.S. dollar rising dramatically, or the weak trend to turn around. We did see the global basket index fall slightly. Euro and sterling both rising against the US dollar, and the Canadian dollar holding just shy of 83 cents. So that's where we're seeing that. We did see the yields on the 10 years go up slightly, just on those inflationary numbers, but still within the range that we talked about. We're looking for it to break through about the 1.84, 1.85, and heading up when we really get concerned around the inflation number for the short term. Long term, we know it's going there, but short term, that's what we're watching for. On the oil front, we did see it spike back above $70 a barrel. As I mentioned, there was some selling off where it fell fell below the $70 a barrel, but it went up a little bit, 1.5%, to break through the 70 again, which is good. And it's pretty much driven by the expectation of resurge in use in the summer months. Gold rose again, just on those inflationary numbers, just a little bit, to a 5-month high. So that's good. So now let's take a look at ETFs. What are they, and how should we use them, and where should we use them? So let's start with the basics here, just so that everyone's on the same page. ETFs, or exchange traded funds, have been around for decades. They became much more popular over the last decade, grown massively, especially in the last 5 or 6 years. And many people are obviously very familiar with mutual funds, and ETFs is a slightly different animal. And the basic difference between the two is a mutual fund is what we call an open-ended fund. So it's a pool of money that is invested for a specific objective. Maybe it's invested in Canadian equities, maybe it's invested in US, maybe it's invested in bonds. But a mutual fund is open-ended, meaning people deposit money into it every single day, and people withdraw money from it every single day. For most funds, not every one of them are daily liquidity, but you get the idea. And basically, keeping track of that in and out cash flow, and the manager having to actively manage that in and out cash flow. So whether they have to sell stuff to have cash, or whether they have to take cash coming in and buy stuff, costs money. So the fees are higher. So as ETFs started to become more popular, people started to trend towards ETFs, and certainly advisors trended more towards ETFs as a more favored solution, because ETFs are closed-end funds. So no money's flowing in and out on a daily basis. Essentially, when they're set up, there's X amount of money in it, the portfolio gets invested, and then people then trade shares between each other on the exchange. The ETF manager, so the company that's sponsoring the ETF, can create more units and sell them on the open market. And they can dissolve units and they make them go away. But that's not as labor intensive, because you're not dealing with individuals, you're dealing with units, and it's an institutional big bulk move all at once. So much lower fees. So, funds in Canada all in might average around 2% annual all-in fees, plus any transaction costs you want to do. Whereas ETFs are well below 0.5%. And in fact, we'll talk about the differences, many of them down at 0.05% these days, to run, and then it's just your transaction or buying and selling cost or management cost if someone's managing them for you. So much lower, which right away ETFs start to look better because then that extra return or that lower cost goes right to you. So if you're buying the same animal, one in mutual fund form, one in ETF form, if there's a lower cost to have the ETF, that's more money in your pocket at the end of the day. That's always a good thing. So that's hence the popularity and growth in ETFs. Now, I'm not going to talk about mutual funds, but I do not use mutual funds generally in people's portfolios because of the highest cost structure, but I will not say they're bad because they're not. And in certain very specific situations, they 100% make sense. So let's park mutual funds for a moment. Let's talk about ETFs. So ETFs started to become very popular early on, basically what we call passive or index ETFs. So these are ETFs that no thought goes into them as far as what's inside them. They just match an index. So for example, if you want to buy the TSX 60, which is the top 60 companies in Canada by market cap and our GDP, you can, instead of going buying those 60 companies on the market, you can buy one ETF that just owns those top 60 companies. No thought goes into that ETF. No one's out there saying which are the best 40 of the 60. No one's out there saying should you be in Canadian stocks or US stocks. Nothing like that. It's just going to own those top 60 companies. Now, should a company fall out of that 60 and a new one put in, it will do that transaction. But for the most part, it doesn't do anything. You buy your ETF, it's passive. You have to then decide whether you want that top 60 exposure or you don't want that top 60 exposure. So there's a lot of different ones in that passive category. You can buy the S&P 500, same idea, top 500 by GDP weight in the US. There's the QQQ, which is the NASDAQ market, which again, it just matches the NASDAQ index. So that's been your technology index in the United States. You can buy a Canadian banking sector. So the top 5 banks, equal weight, top 5 banks in Canada, 20% in each one, right? Equal weight across 5. That it will rebalance it back to that 20% weighting every now and then. Depending on which one you buy, they'll tell you whether it's monthly, quarterly, or annually, they do a rebalancing, but it just owns those. So you can be very targeted from a passive nature. You can buy them for bonds, same idea. You can buy a broad bond index. You can buy a Canadian short-term bond index. You can buy a US, you can buy an international. You can buy gold. You can buy any market you think of globally. You can buy an ETF on the passive side of things. So on the passive side of things, okay, let's park that for a moment. Let's talk about the active side of things. So now you can also buy ETFs that actually have thought put into them. And there's a few different ways you can have that. There's the manager might be putting thought into it. So an individual is managing around a specific goal. So it might be, I want, Canadian stocks that pay, the best dividends. So there might be a manager selecting the stocks that go into that ETF that would make up the best dividend paying portfolio using only Canadian stocks. And again, you can do that globally. You can have a manager with pretty much, again, there's so many ETFs out there. You can pretty much have any actively managed goal you want. You can have it, as I say, global companies. You could have it around growth. You could have it around technology, pretty much anything. So you can have an active portfolio. Those ones, the management fees are going to be closer to the 0.5 because now there is work being done in there. There's more trades being done. There's a manager overseeing things. So those ones are going to be closer to the 0.5. The passive ones are going to be closer to the 0.05. And then in between those two, you have thematic type of managed ETFs. And that means there's more trading. It's around a specific goal, but it's automated. So it's not an individual that's making the decisions, it's rules-based. So that means it basically says, here's a calculation to determine what's the best one to be in there, the best ones to be in there. Whichever ones fit that calculation, they go in. If it doesn't fit this calculation, it doesn't go in. And it will change them as they fall in and out of that calculation parameter. So those ones are again, in the mid on the pricing, because there is obviously programmers, there's a bit more trading activity within them, and a bit more active within the portfolio. But as far as you're doing, you're just buying the ETF. You don't have to do anything. You selected it because you want that. So where should you use these and how should you use these? So I'm going to kind of give you the broad scope of this, and how you can build a couple different portfolios, and then I'll give you my opinion, and I'd love to hear your opinions if you have different opinions or you use different opinions on this. But there's kind of two different schools of thoughts out there. Active versus passive. So passive would be, you would go by, say the TSX 60, the S&P 500, the QQQ, a couple of bond ones, and maybe a global exposure based on an asset allocation of your risk, right? So if you've determined your risk is, 50-50 equities, 50% income, you would buy 50% of that in a range, maybe a short-term fixed income, a mid-term fixed income, and a long-term fixed income. And then your 50% equity, you might go buy a broad Canadian passive, a broad US passive, and a broad global passive, right? And then there's your passive portfolio. Maybe once a year you look at that and you bring it back to that 50-50 percentages again. And that's a passive approach. So that's one way of looking at owning ETFs. Be very low cost to have one of those portfolios, but you will get the volatility of each of those underlying markets dependent on what's going on out there. The active philosophy can take one of two approaches. The one approach, if you want to be as hands-off as possible, is to go buy some active ETFs. So, buy some broad active ETFs, but allow the managers, so they're broad enough that the managers that are looking after those ETFs can make the decision as to should they be short-term bonds, should they be long-term bonds, should they be mixed, what that mix should be. On the equity side, should they be in Canadian large cap dividends or small cap growth? Should they be more US, more Canadian? What should they be doing on the global front? Which sectors to be in, et cetera. So you can buy those ETFs and still be passive on your side, maybe rebalance them again once a year, but give the power to the managers within the ETFs to make those shifts around for you. Or there's one, and here's where my opinion falls in, is if you're working with an advisor particularly, is to use passives to be very targeted. So now you and your advisor are making decisions as to where to move around those markets by using very targeted passive ones. So if you want to have extra exposure to the Canadian banks, you would buy that very specific one, as opposed to buying the TSX 60, which would be very broad. If you want overexposure, I've talked about, cybersecurity, or the electrical car market, or gold, or, right? You can be very, very targeted. And then, of course, the responsibility is now between either yourself or your advisor to decide when to, move out of oil and into banks, or out of banks and into technology, and be active that way, but using the lowest cost access to get active management with your ETFs. So that's kind of how to use them. They're very transparent. They can be very diversified, very liquid. If you're trading them yourselves, do watch liquidity, because Most ETFs don't have price and spread. And when we say price and spread, so when you're trading on the market, there's always what we call a bid and an ask, right? So someone's offering for sale and someone's trying to buy. And you can have a price difference. Someone might offer, at $10 and someone might, only put out $9. So, there's a spread, and who's going to move and pay extra or get less. Most ETFs have a very tight spread, meaning pennies. So you're not really worried about that spread. You would just go buy it at whatever, it's offered up at, and you're not going to, or you'd sell at what, someone's buying it for, because, 1 penny on 100 shares is $1. It's not going to make a big difference to your portfolio. But sometimes when there's lower volume, you do get a spread between those numbers. So if you're trading them on your own, be very cautious in liquidity, how many shares are trading per day and how big that spread is. For us, if you're going through an advisor, you don't have to worry about it too much, because remember I said the sponsor of the ETF, the manufacturer of the ETF can create and destroy units. So if we are doing a big order for clients and there's not enough liquidity, we can just contact them because it's large enough, they will just create an institutional units for us, and then we'll just get it at that very tight spread, basically at the value of the portfolio or very close to the value of the portfolio, again within pennies, and get covered on liquidity. And the same on the sell side, they'll destroy some units if they need to. So not usually a concern, liquidity, but if you're buying one of lower, just be aware of that. Especially if you're buying on your own in very small volumes, because of course they won't do an institutional amount for very small volume. And as I said, kind of the cost to run these things. Always be aware of what you're paying for that management fee. We do a screening of all ETFs because for TSX 60, for example, there's probably over 100 TSX 60 ETFs out there. So we look at the lowest cost one and make sure they actually track the TSX 60 as accurately as possible. Because if it's not tracking the TSX 60, I'd rather pay an extra 0.01% for one that tracks it really well. Otherwise, you're not getting what you pay for. So I wouldn't worry too much on the cost side, but do be aware of what you're paying, and I would shop around to make sure you've got a good one, and that's what we screen for. Now, if you're not strictly invested in ETFs, some people have apprehension, they prefer individual stock positions. And I get you. And on larger portfolios, individual stock positions can a lot of times make sense over ETFs, or you're very targeted for a certain type of growth or risk. Individual stocks make a lot of sense. You can diversify targeted to yourself. You can control your taxation a little bit better. But sometimes ETFs do make sense. For example, in global markets, if you want to get access to emerging markets, or if you want to get access to BRIC countries, right, like Russia and India, where you can't get access to the underlying exchanges very easily or cost effectively or timely, like a lot of times because different hours of market operations. They might be a complete opposite our market hours. So, you put in an order and you won't get filled to kind of the next day, and you can't really pick your price in. Whereas at least the ETFs, you know the exposure you're having, the price access you're getting. And if you choose one of those active ones versus a passive one, at least the manager is actually trading live on that market all the time. So you are here, but still getting access to that benefit. So they can make a lot of sense in a stock or individual security portfolio when you're trying to duplicate something that would be more costly, more time consuming, or just plain harder to do here in Canada versus where the underlying exposure is. Or maybe you want to get access to an illiquid underlying market where you can't go out and buy the securities that easily, or can't get exposures to that underlying sector or particular area directly. You might want to use an ETF as a pseudo exposure to it, that's easier for you to get access to and easier for the manager to deal with the liquidity side, and you don't have to deal with those kinds of things. And that's true of even a fixed income, right? Of bonds. A lot of bonds trade in very large blocks, and for individual buyers to get access to it, even if they do get access to it, they usually have to pay a premium because someone bought the large block and divided it up as a middleman or a middle person, and you're paying a higher price for that. So buying the ETFs is buying those large blocks, and then you're getting that translated straight through to you without having that middle person take a cut on those exposures. It makes all of a sudden ETFs become very worthwhile in your portfolio to give you that kind of diversification that you need. So that's all I want to talk about ETFs. I thought it was worthwhile doing a refresher. If you have any questions, you want to look at your portfolio, you want to see what you're paying, or understand more what you have in there, reach out to us at mikeonmoney.com. Go check out our series on cryptocurrencies that we took a really deep dive in. Each video is consumable, only about 10 minutes, but together there's 40 minutes of video there to watch, but you can do it on your own time. And if you want the links to those, just reach out. So with that, thank you again for joining us for a live Tuesday. If you want to watch the replay later, we'll have it up and the podcast will be up as well. Take care and enjoy your week, everyone. Talk to you soon.